The U.S. Federal Reserve cuts interest rates, signaling that inflation is being tamed. What will the impact be in the country and beyond? Hello, I'm Anand Naidu, and this is The Heat. It wasn't a matter of if the interest rates would go down in the United States, but by how much. The Federal Reserve, the country's central bank, surprised some analysts and decided on a half percentage point cut. CGTN's Owen Fairclough explains the importance of this first cut in 4 years and what the ripple effect could be.
In any other era, a central bank raising or lowering its benchmark interest rate would be unremarkable beyond stock markets and policymakers. But the US economy has been through extraordinary times. First with the COVID-19 pandemic and the US central bank, the Federal Reserve, slashing its main interest rate to zero to ease conditions for consumers to get credit and for businesses to expand. But when pent-up demand began to soar in the wake of that pandemic, inflation started to spiral and the Fed was forced to raise its interest rates to the highest levels for years to drive down inflation. But the Fed has decided that battle is over now, with inflation close to the Fed's 2% target. And the Fed has decided it's time to cut that main interest rate. Here's the chair of the Fed, Jerome Powell.
In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%.
But the size of that interest rate cut, a full 0.5%, will fuel concerns among some skeptics that the Fed has left it too late to cut that interest rate and is now acting aggressively to drive that rate down. And they point to certain numbers. Let's take a look at those. The unemployment rate here in the United States stands at 4.2%. Now, it did dip a bit in August, but it's been rising gradually. Also, hiring has slowed down. Both of these factors blamed on that benchmark interest rate by the Fed being so high for so long. And yet the GDP, the economic expansion of the US, is forecast to be around 2.6%. That's the forecast by the International Monetary Fund, which is optimistic about US growth. And it's worth noting that Powell says that 0.5% interest rate cut is a sign of confidence in the US economy, not a sign that things are going wrong. So what does this all mean for consumers in the United States, particularly those trying to get on the housing ladder with mortgages at the highest for years? Well, the Fed is thinking that it may continue to cut those interests, that benchmark interest rate gradually through 2025 until it reaches around about 3.5%. That's considered the level at which that rate neither hinders nor accelerates the US economy. So for mortgage lenders, well, they think that by the end of 2025, the average 30-year mortgage rate here in the US will be just under 6%. That's still relatively high compared to that real estate boom during the pandemic when those interest rates were low and you could get a property for around a 3% mortgage. Most insiders, most policymakers say don't expect mortgages to go back to that kind of rate anytime soon. Owen Fairclough, CGTN, Washington.
Okay, time to bring in our guests. From New York, Anthony Chan is former chief economist at JP Morgan Chase. From Kunshan in China, John Quelch is vice chancellor of Duke Kunshan University. Klisman Murati is the founder of Pareto Economics. He joins us from London. And from Los Angeles, Ryan Patel is a global business executive and senior fellow at the Claremont Graduate University. Welcome to all of you. Anthony, we've been talking about this for some time. The Federal Reserve has announced this cut, 0.5 percentage point. You know, we were discussing this a few weeks ago, and we were saying it could be a 1/4 point, it could be 0.5 point. Does 0.5 point surprise you?
Well, I think it is somewhat surprising because the Federal Reserve tends to be cautious. And by lowering interest rates by 50 basis points, it leads some people to come to two conclusions. One, things must be really bad, or two, that they have growing confidence that the inflation numbers are under control. My suspicion is that it is the fact that they have growing confidence that inflation is under control rather than the economy is bad, because the numbers certainly don't bear that.
You know, our reporter there made reference to some analysts who said that maybe this was too late, and that's why some of the unemployment numbers are creeping up. What's your take on that?
Well, we did get actually a dip in the unemployment rate to 4.2%. The Atlanta Federal Reserve this week, after the retail sales numbers came out, really gave you a very respectable number for real GDP in the third quarter. 2.9% is the number now. And in fact, consumer spending is expected to be 3.7%. Those are not numbers that spell recession in any way, form, or shape that you can imagine. So these are not numbers that tell you. And in fact, even equipment spending is expected to be over 11% in the third quarter. So these are not inflationary type of signals that you would expect. So yes, the Federal Reserve did get a little bit of a late start. The European Central Bank and others got a little bit of an earlier start, but the numbers don't seem to suggest that the Federal Reserve is late in the game.
Right, Ryan, this is being described as something of an aggressive move, but the Washington Post reported today, and it said, it quotes an economist rather, as saying that this is great news for the middle class. I mean, how will this decision affect the lives of normal Americans?
Well, I mean, it's a start, right? You won't feel that effective right now today. I mean, there's two things that this starts for the middle class, right? Can it relieve the pressure on pricing? And that's going to see over time in policy over the next 6 months. I think the second piece, which I think is on top of mind for the middle class too, is jobs, right? When you think of inflation being tamed, you have to tame it without sharp increases in unemployment rates. And so that to me is a big kind of a fear right now for the middle class of how secure the job is and is spending right back. And I think that's kind of the aspect of what the nervousness is about, is like, okay, you got the 50 basis points, what's next?
Right, so you say it's about confidence. What does your gut feeling tell you? Where's this heading?
Oh, the gut's sometimes not always right, but right now it feels like this was a reaction. This wasn't, felt like could have done a little bit earlier in the year, and I think most people would agree that was the case. I think my gut tells me that it's a wait and see till December. I'm very interested to see if they can keep up this pace of it. So I don't think we're out of the woods just yet. I think it is good news. We are seeing numbers, but there's still very many variables still in play. So I'm not going to jump on the bandwagon and go, everything's going to be all A-okay. I think that, we still got to go through the fourth quarter holiday spending. Yes, we're seeing numbers, but it's not enough yet to point that everything's good yet.
Yeah, not even Jerome Powell is saying that everything's A-okay. Klisman, good to see you. Thanks for joining us from London. Now, at that news conference on Wednesday, Powell said looking ahead, the Fed will look at interest rates from one meeting to the next. Let's listen to some of that.
The goal is to have inflation move down to 2% on a sustainable basis. And, we're close, but we're not really at 2%. We're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
So, Klisman, how do you see the next few months unfolding? The Financial Times says that this heralds the era of easing. I mean, is that what it is, or is it too early to say?
I think you can get very academic with your analysis on what Jerome Powell says and what these macro factors mean for the economy. But if you're looking at consumer economics, I suppose you say, this is great news for the middle classes, because their focus is on how can my spending power be increased and what financial pressures can be decreased by these decisions. I think this move was rather fast and rather swift. Half a percent is rather bold, I think, in my opinion, considering what other central banks have done. So can this pace continue? I don't think so, only because a lot needs to happen in the US economy in the next couple of months for there to be an equal rate decrease or anything close to that. So I think he's setting himself up for, high expectations for the future, which doesn't look good on Jerome Powell, but the economy will continue the way that it's gone. I think consumer spending for Christmas may not be where analysts think it will be, because again, there are pressures of household pressures, and we will see more rate cuts, but I think at a much slower pace the next time around.
Right, so Klisman, when you say we will have to see what happens in the US economy in the next few months, what will you be looking for?
Well, I'm looking at the unemployment rate really, because, and I suppose you'd say that Powell front-run the creeping unemployment numbers. So unless businesses have a long-term view as to what the economy looks like, and there's confidence in these companies to hire people because they know that the future looks brighter, then unemployment will remain where it is and will creep higher. I think what Jerome Powell's job is to set expectations for the middle classes and also for businesses so they can plan their investment strategy, whether it's buying a house, investing in a new factory, or hiring people, so that they can plan for the long run. The actual interest rate itself doesn't matter as much as what their perceptions are for the future. If their perceptions are negative, then even if interest rates are low, then I don't think you'll see that much activity. But even if interest rates are high, but there's high expectations because there's good fundamentals and there's a strategy and a plan forward, then people will still invest into the future. I think this shows that, you know, the consumer and also the high street, as we call it in the UK, is still not as confident as it needs to be.
John Quelch, our reporter, talked a little bit about the housing market in his report, referring to what this might mean for the housing market. I mean, analysts have told us that the rate cut will bring some relief to the housing market, but economists are also warning that any kind of relief or advantage will not come in the short term, because lenders have already factored in this rate cut into their rates of interest. So will we have to wait a little bit to see how this unfolds for things to settle down?
As you know, and usually interest rates and prices take the elevator up and the staircase coming down. And so it will take time for this half-point adjustment to work its way through to consumer-facing loan rates. I think the 30-year loan rate is now approximately 6.2%. It's down from 8 or so in early 2023. It's definitely going to come down, but depends a little bit on how competitive the banks are in terms of channeling the Fed rate cut through to mortgage rates. I don't feel that there's a tremendous appetite among the commercial banks to address the housing market, to address the mortgage market. At the moment, I think they're sitting on the fence a little bit still. And so I would be a little bit circumspect, expecting rate cuts in the mortgage market very soon. They will come down, but on a gradual basis.
Anthony, what are your thoughts on the mortgage market?
Well, I just wrote a paper on Substack on the housing market. I found something fascinating under the People's Economist. I found that when people talk about the fact that consumer confidence has plunged, they always say, oh, look, the consumer price index is the reason why it was a problem, because the consumer price index from pre-pandemic to now is up 21%. But the reality is that average hourly earnings are up 23%. So the earnings actually exceeded the rise in the consumer price index. But what did not happen is that if you look at existing home sales prices, let's say the median sales price, that was up 58%. And if you look at the mortgage rate and you normalize it, you set it to 100 back in January of 2020, and you compare it to what it did in say by July, it was up 88%. Mm-hmm. That was the real reason why consumer confidence took such a hit. Now, as mortgage rates come down, as you heard, mortgage rates came down from last year already, even before the Federal Reserve started lowering rates, and they will come down a little bit more. And you see the consumers becoming a little bit more confident. We will see the home affordability picking up. And that's what's going to boost consumer confidence. That's what's going to boost the overall economy. I think housing, which has been in a recession for quite some time, it rose in the first quarter, but then in the second quarter it went down, and even the Atlanta Fed is projecting an 8.5% decline in residential housing. Mm-hmm. But as these rates come down and confidence starts to pick up, I expect that the housing sector is going to pick up. It's only 4% of the economy, but it's certainly it will be a positive contributor by the end of the year, and certainly in 2025 as these rates come down, because already expectations are that the Fed will lower rates 100 basis points this year and 100 basis points next year.
Ryan, inflation spiked during the pandemic, and the Fed Reserve leaders thought that it would be temporary, but that wasn't the case. So what were the core reasons for that rise in inflation, and have those been addressed?
That's a great question. I don't think it's been completely addressed just yet. I think that's why the policy, we said Jerome Powell, like you mentioned, isn't 100% sure to that degree. I also think that there were some mixed numbers in there. Right? The consumer was really resilient, right? And so then you see investments and even IPOs this year has been on a rise, not compared to last year. So we don't see the full confidence back into the market. And so again, I think this 50 basis points, and I think this conversation actually started a handful of weeks ago when the market took a turn for that week. If you recall, when Intel cut its jobs, there was a week of bad markets, and Jerome Powell came out and stated that, oh, I think there's going to be a market, a cut in September. And why I bring that story up on it is because this is where we are today, right? Nothing's changed from that point to this point over the last 6 months. We've just seen the continued slow growth, but in multiple variations of an answer that they're looking for. And this is kind of where they decided to plant the flag and say, now it's time to go down.
Klisman, a number of commentators in the media today are saying that the U.S. economy is heading for a soft landing. I mean, is that the case? Or is there still a risk of overheating given that half a point, 50 basis points cut?
Look, if we're looking at the U.S. economy as a whole, it's obvious to see that there are some sectors that are doing better than others. But what we really need to understand is soft landing, hard landing, they're all very good and sexy languages to use when it comes time to these things. But what I'd rather focus on is how the...
Oh, apologies, we've lost Klisman there. We'll try to get back to him. John Quelch, how will this Fed decision impact the global economy? I mean, could we see an expansion in trade? Could we see an expansion in production?
This is extremely good news for the global economy, and I hope that there are many more interest rate cuts to follow, albeit on a systematic and progressive basis. There's no doubt that global trade has suffered as a result of the U.S. High interest rate regime. And of course, in addition, all dollar-denominated debtors, including nations, especially in the global south, have suffered considerably from the very high rates in the U.S. So this is very welcome news, and the fact that it's half a point as opposed to a quarter point will be exceptionally well received around the world. We expect, obviously, to see other interest rates, central bank interest rates coming down in other countries in sympathy with the the Fed reduction in the funds rate here.
Well, I'm glad that Klisman is back with us. Klisman, you were talking about the U.S. economy heading for a soft landing.
Yes, I think when you're looking at the U.S. economy, there have been signs that I think a soft landing is much more likely, because there is still, no matter, although you may say, why did you mention the fact that unemployment is on the rise and we're going to have a soft landing? Although that is the case, it seems to me...
Oh. We have a problem there again. Anthony Chan, there was a commentary piece, opinion piece in the New York Times written by its well-known columnist, Paul Krugman, and he said that he would like to see the Fed cut 3 percentage points quickly and right now. What is that about?
I think that's about growth picking up, and he's obviously worried about lower income individuals, and there's nothing wrong with that. I think that that's too risky. I think that they actually went outside and thought outside the box, and by lowering rates by 50 basis points, I think they went right on the edge. But I think if they lowered rates by 3%, then again, it runs the risk of overheating the economy. I actually think that the economy is doing okay right now. There are risks out there, and there's always the risk of a potential hard landing. But remember, that inflation has come down. When you look at the Federal Reserve's favorite inflation indicator, the personal consumption deflator, that's come down from over 7% to 2.5%. So when you see an inflation rate that low and the Fed funds rate is still at its peak, there is room to lower rates, not by 3 percentage points in my judgment, but certainly to continue to lower rates gradually. And why gradually? Because it allows you to see what the impact is on the overall economy. If you lower rates by 3% and something goes wrong, you're not going to raise them again back by 2%. That would send the wrong signal to financial markets.
Right, Ryan, what are your thoughts on the risks inherent in cutting too much?
Yeah, I mean, it's a huge. I mean, I think it was a great point that there is room to cut the risk, but the problem becomes is if you cut the risk, if you cut the interest rate that much, does that jump overseed some more spending that's not necessary? We're still at an all-time debt high for personal consumption. There's a perception that everything's still okay when interest rates are lower. Not to say that the fundamentals of the economic procedures are important, but they are important. I think there's a better risk of kind of a lesser risk to gradually decrease the interest rate. What I'm really afraid of is that we have a cut like this, 50 basis points, and then there's no more real legitimate cuts. That's what I'm more afraid of than actually the other way around. And so that, to me, the Fed has to stay consistent here and stay onto that frame. This is not the time to go, well, in 4 years, this is what our number is going to look like. Either, like it said, stick to the plan. Here in 12 months, we want to see 150 basis points to 200 basis points, and that's our plan. That's how we're going to do it. Don't go away from that should the numbers stay what they are today.
Right. I want to stay with you for the one other factor, and that is the U.S. national debt. The Wall Street Journal reports neither Donald Trump nor Kamala Harris are paying much attention to it in their respective campaigns. I mean, how much of a risk is the national debt to the U.S. economy?
I can say this blew to my face. It is so important to the U.S. national debt because no one's addressing it. Because guess what? We talk about it only when the government shuts down, which we are going to kind of come to that point. And then both sides, it's a bipartisan approach that needs to come on and keep these things keep going. And it really does have to address, and not just address the national level, but also a personal level, what I was just mentioning of personal debt and credit card debt. Not to say they're connected, but they are. How do you manage that? And so if you just ignore every time the U.S. national debt comes to fruition and go, okay, 6 months from now, we'll just increase it and keep doing this. Someone has to address this. And unfortunately, why neither party is probably not wanting to talk about it is because both parties need each other to actually solve this problem and to come to terms onto it. And as you can tell, this is something we should be talking about. This is the perfect time to talk about and how to get the infrastructure spending, get the GDP back to where it needs to be to fund a lot of these things and not have to take more debt and focus on the fundamentals.
Right, John, you were talking earlier on about the global impact of the rate cut, but looking abroad at some of the interest rates there, I mean, in England, inflation appears to be under control, and the Bank of England is expected to keep interest rates where they are right now. That's when they meet. I think they meet later this week. I mean, what about the inflation rate there, or in the member states of the EU?
Well, as far as the UK is concerned, although the inflation rate at a total level appears to be under control, there's quite a high inflation rate in the services sector still. Goods, manufacturing products, inflation there is very low at this stage because all the supply chain issues that contributed to it have been pretty much worked through. But where there is inflationary concern is in the services sector, and this applies to other countries in Europe because we have essentially a wage price inflation component to the equation now, where so many trade unions, so many workers have pressed for compensatory wage adjustments as a result of the high inflation rate, and those have been especially noticeable in the service sector.
Anthony, I was talking to Ryan there about the political impact of some of what we are seeing now from the Federal Reserve. I mean, are you surprised that it's not being discussed in more detail by Donald Trump or by Kamala Harris? And why is that?
Well, they're not talking about the deficit because it certainly doesn't fit with their agendas. They all want to spend a little bit more. Today, you did hear Donald Trump talk about the fact that the Federal Reserve move may have been political. He gave two options. He said it's either that things are really bad, which they're not, or the movement was political. I don't think either case is true. I think that they lowered interest rates as an insurance policy, and they said that moving forward, they will either continue to lower rates at a given pace, or they can even have the option of pausing. So they're giving themselves optionality, despite the fact that they moved aggressively in the first rate cut.
Ryan, what about the labor market? Is that something that could come under discussion? Is that something that'll be closely watched? Because you know, the unemployment numbers is something that resonates very quickly and understandably with voters, doesn't it?
Most definitely does. And I think that labor market is the one that maybe gives, this is why I don't think the Fed wanted to say we're going to have this complete plan. The labor market is the one who will pause maybe the interest rates or even maybe decrease it further. I think the labor market is the wild card in all of this, because when you see more jobs getting lost, you see the economy, should that occur, the economy takes a hit, people spend less money. You know, we're going into the fourth quarter where holiday spending is there, we see less. It does provide a wake-up call or a rattle to Wall Street. And then all of a sudden, the dynamics and variables that you made a decision on 50 basis points and where the economy is going has a different trajectory. Again, we're not there just yet, but you mentioned the word labor market. It makes everyone pay attention, and you need to understand how those numbers are going.
John Quelch, of course, there's a big look right now at the future of the economy, which way it's heading, etc. We have to talk about the relationship between the United States and China, the trade relationship. Do you think, you know, if the U.S. wants to have a very positive outlook on where the economy goes, that we could see an easing of those tensions, trade tensions that we have seen?
Well, that's a very difficult question. Both parties are very much doubled down on China rhetoric, and Donald Trump, of course, has proposed a 10% tariff on all imported products, which would seriously affect trade out of China to the U.S. So I'm hopeful that post the election there'll be a calming of nerves, and there won't be so much rhetoric that will take away from the opportunity to reset the relationship in economic terms, and perhaps to develop some compromise agreements on a number of the issues that have proved recently to be fairly intractable, though it's certainly encouraging that multiple members of President Biden's cabinet have shown up in Beijing over the last year, and that certainly eased tensions.
Okay, and that is where we have to leave it. Thank you to all of you for being with us. That's it for this edition of The Heat, but the conversation continues online. Join us on CGTN America's Facebook page to comment on this or any other show, or chat with us on X at CGTN America. I'm Anand Naidu in Washington, D.C. Thanks for joining us.